Chat with Traders, episode 147, is backed by the good people at TradeStation. So while you're listening to this episode, take a moment to discover why TradeStation are a popular choice as a broker and as a technology provider amongst professional traders. And when I say professional traders, this actually includes a bunch of my past guests. When you see TradeStation's cost-saving commission structure and advanced platform features, you'll soon understand. Visit tradestation.com/traders.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey guys, what's good? You're plugged into episode 147. Let's get this going. So my guest here with me on this episode is Dr. Thomas Starke. Thomas is a physics PhD who once designed microchips, was an engineer for Rolls Royce, lectured at University of Oxford, all before applying his knowledge of modelling to financial markets, working at a fund and then joining a well-regarded Sydney prop trading firm as a quantitative developer and trader. And it's only very recently that he's left this role. Thomas was great to chat with. Not only did we discuss topics related to quantitative trading, strategy development, and robustness, but also his infatuation with the rise of artificial intelligence and quantum computing. I think this conversation begins around about the 50-minute mark, roughly. As you'll hear, we mentioned quite a few links, resources, and different things during this episode. You can find all this curated at chatwithtraders.com/147. And while you're there, if you're feeling generous, please pick up a Chat with Traders t-shirt to support the podcast. Just click the t-shirt link in the main menu. And finally, I'd like to give a quick shout out to Kelly Scott at Trading Technologies. She's the one responsible for introducing me to Thomas and helping to tee up this interview. So thanks very much, Kelly. That's it. I'm Aaron Fifield. This is Chat with Traders podcast. Here is my guest, Thomas Starke.
Hi, Aaron.
Hey, Thomas. How you doing?
Good. How are you?
I'm all right. It's
All good?
Yeah, I'm telling you, it's not been my week this week.
Oh, really?
Yeah, I was interviewing someone yesterday, and we're about 20 minutes into the interview. It was going pretty well, and then we had a power cut here at home. Everything just switched off, obviously, and I lost everything. Well, when I say everything, I lost the recording. So
Really?
that was a pain. Yeah, but it's all right. We've rescheduled for a couple weeks' time, but
Oh, man. I can imagine. That must be gutting.
right, yeah. Bit of a black swan event. It's the first time it's happened since I've
Yeah.
been doing the podcast.
Yeah, these things happen, I guess. And especially because you do so many interviews, there's bound to be occasional hiccups.
Right, exactly. But anyway, how have you been? Recovered from your cold and all of that?
Yeah, slowly getting there, but still, it's still a bit funny. I'm still not 100%, but I'm more than okay to talk. I've been working quite a bit, so, but I still feel it. It's been a real drag.
Yeah, I mean, traveling often does that as well. How did you go in Singapore? How was QuantCon?
It was really nice. I really enjoyed it. It's always good to meet interesting people. So I'm friends with Andreas Klanov, and it's always nice to exchange ideas with him, especially to hear about his ideas about Bitcoin and more cryptocurrency things, and also the whole Quantopian crew. They're really nice people, and I always enjoy hanging out with them. Very interesting.
Oh, that's good. And what did you speak on? What was your talk about?
My talk was on how to was actually on overfitting and how you analyze strategy parameters. So let's assume you backtest a strategy, and you want to know whether that strategy has any merit at all. And most people, they just optimize that and they find the best parameter set, and then just see whether that works going ahead, which is, the traditional way of doing things. And you're probably aware that recently there have been a bunch of papers coming out on something called system parameter permutation. And basically the idea is that rather than throwing away most of your data from your test set, you run your whole strategy through the training and the test set equally. And then you do something like a linear regression between the results from the training set and the test set. And if you can see that there is a correlation between them, you can say that that strategy that you've developed has some sort of predictive power. And that can really help to say whether your strategy has any merit. Of course, there has to be a bunch more tests, but that's really one interesting way of looking at it. And so what I did at QuantCon was it's an experiment to instead of just giving a talk and showing some graphs, I actually presented a whole IPython notebook with all the calculations and even the strategy with the optimization on it, and demonstrated that live in front of everyone. And I think it went down really well.
Oh, excellent. Is that IPython notebook, is that available on your website, or is that just for the talk?
Yes, it is actually available on GitHub.
Oh, okay.
So I made that available. I can send you the link to that.
Yeah, we'll get that link and we'll stick that in the show notes in case anyone wants to check it out.
Sure.
Now, I don't know if I understood you correctly when you were describing what you spoke about there, but you're talking about using the in sample and outer sample together all at once. Did I?
Exactly. Yes. So what that is you look at the in sample, and at the same time you look at the out of sample. So you run all your parameter sets. So the strategy has say in this case, I just used a really, really simple moving average crossover strategy just for demonstration, because otherwise it would run way too long. I just ran it through an in sample period and then through an out of sample period. And I basically took all the data that I have from both periods. And then what you can do is a regression between the results. So you could, for example, regress the P&Ls with each other, or the Sharpe ratios, or even the drawdowns. And then you look at whether your in-sample period actually does inform the out-of-sample period. And if you find that there's some sort of correlation, then you can say, oh, there is some information in that strategy. Because if you just see a round blob, effectively, then there wouldn't be any information content in that strategy. And even though it might have some really good results somewhere, it doesn't really have any merit in terms of what it can do, most likely.
Well, before we dig too deep into this, I think it might be helpful if we can hear a little bit about your past and sort of where you're coming from. So, I know you've had an interesting path leading into trading. I think you worked with Rolls Royce at some point. You've been an engineer with something to do with airplanes and that type of thing. Just give us a little bit of context about some of the things you were working on before coming into trading.
Yes. So I've actually done a physics PhD in the UK, and then went into several parts of electronics, mostly microchip design. So I was part of a startup company in Wales developing microchips. And from that, I moved on because I got a position at Oxford Uni and did research there and some lecturing, and got more and more into computer modeling. And doing that work at Oxford, I also got a call from Rolls Royce. They were interested in me doing some work for them on airplane engines. So I spent my time at Rolls Royce developing airplane engines, but I realized that the big stuff wasn't 100% for me. And so I moved back into microchip design. I was always more interested in the small things, and came to Australia, worked here in the microchip world as well, developing or working on some of the developments on some of the world's fastest inkjet printers. And during that time, I developed an interest for trading. Initially, I had actually done a bit of day trading before during my PhD just to support my small salary there. And that was pre-2000, so the times were pretty good for some intraday trading. And when I started this during my time in Australia working on microchips, I just thought, well, I'm building all these computer models. I'm using a lot of distributed server clusters to do this, lots of data. Why should I not try to build some models that can trade for me on the stock market automatically? So basically build a robot. Now I, at the time, really didn't know if any of that existed. So I just got started, and bit by bit, I learned more and more about finance and trading and what it all does. And also I learned a lot more about how to set up software systems and computational work, because one thing is when you are a physicist and you build models, and another is to actually build proper computer systems that can support a automated trading system. So that was really my my beginnings, and then finally I came up with some interesting models. I hooked them up to my broker and ran them for a while, and whilst doing that, traveled the world and learned more about trading until eventually I ended up getting some jobs in the financial industry. So that's basically that.
Okay, and those jobs were with a prop firm, correct? I mean, you don't have to name the firm if you're not comfortable with that, but it was with a prop firm, wasn't it?
That's right. Initially, I started working for some investment funds and hedge funds, and my last job was for a Sydney prop trading firm.
Okay, and did you find, I don't know if this question might be a bit of a stretch, but were there any transferable skills or any similarities between what you were doing in the physics world which crossed over to helping you or gave you some advantage with what you were doing in trading, like the models you were developing, etc.?
Absolutely. Initially, when I started, I think I wouldn't have been able to build any models without my numerical background in physics and computer modeling. Now, I don't think that physics directly impacts trading, because whilst the laws of nature are kind of immutable, the laws of the market are very mutable and they change a lot. And so we have different dynamics going on there often. However, a lot of the numerical skills, the IT skills, and also reading data, understanding data, and also being able to read financial research papers that are often quite mathematical has really helped me to develop my own models quite to a great extent. And I don't think without my training, I would have been able to do that quite the same way.
So I'd like to spend a bit of time speaking with you, Thomas, about strategy development and things related to that. I know we started getting into it right at the beginning, but just to backtrack a little bit. So, I mean, I'm sure there's going to be some things which you've got to be a bit careful about talking about, respecting where you've worked previously. But can you just give us like a high-level overview or a bit of an idea about the types of strategies that you've worked on in the past? Like, you don't have to go into granular detail, but just give us a bit of an idea on the sorts of strategies that you've worked on.
Sure. So initially I started with much more trend following strategies, because that seemed to be the most obvious thing. And also there was a bit of literature available. And so I initially built those first for just a few a few different instruments, and then for larger universes of portfolios. So I learned how to assign the positions correctly, or more or less. Obviously, you can never assign them fully correctly, but how to calculate position sizing properly and so on. And then more and more, and until recently, I moved more into a factor modeling type approach with my strategies. So I look at universes of stocks, find interesting factors that might have some sort of correlation with the returns of these stocks, and then I rank the stocks accordingly and trade those according to their ranking, and also assign portfolio positions according to their ranking. And there's also another approach where you pre-select a certain portfolio, and then you do research trying to find certain factors that will describe the returns of that stock to some extent, and then effectively run your factors on that portfolio, and rather than in the previous approach selecting certain stocks from a specific universe. I hope that makes sense.
It does, yeah. So when you're talking about factors, or the sort of factors that you're using, are these still looking at price action and price in of itself?
Some of them do, but more and more I move away to alternative factors because it's quite well known now that price action gets harder and harder to trade on. So I get quite a bit of inspiration from academic papers, I have to say, but also from some of the blogs. And recently, or a while ago, I was really interested in different types of sentiment and how you could trade that. So there's a whole lot of sentiment providers out there, and hence we do get different types of sentiment. We get Twitter feeds, we get sentiment from news articles and so on. So they make, for example, very interesting factors. There are also interesting factors based on actual machine learning. So you could, for example, train a machine learning tool to basically take different price actions of different assets or whatever you're interested in, and then see how this can predict returns in your underlying assets. And sometimes you find quite interesting behaviors there. Now, I found that machine learning by itself mostly cannot, you cannot run a full strategy just purely on machine learning. There have to be other factors as well, but machine learning itself definitely makes for interesting factors in my models.
These alternative factors, can you give us a few examples of those? I think you maybe just did. You described sentiment there. You described machine learning is a tool that can be used as well. Can you give us an example of maybe some other alternative factors that you've found to be helpful?
So there's several providers of interesting alpha factors out there now, and some of the more well-known factors that you can get from these companies are, for example, stuff like coverage of cars in front of car parks of big retail stores, or you may have heard of there's sometimes at oil refineries you have lids, and you can figure out by using satellite imagery whether those oil refineries are really full or they're quite empty, and then you can say something about the industry as a whole and get some interesting data. There's things like crop data, satellite crop data, that are very interesting. and there's all sorts of other interesting things. A lot of that I'm more interested in now has to do with a satellite imagery and what you can do with that actually.
So you yourself are using satellite imagery, or you've played around with it?
Yes, I have. So this is something that I'm really interested in at the moment, and I'm playing around with it. I'm still working on some of those models. It takes quite some time to really get them to work, because it's an incredible amount of data that you have to sift through, and it takes time. It takes time for the computing and so on, and then to correlate that with what you think it might be correlated to. But it's definitely very fascinating, and I'm always interested in those new technologies and fascinated by that. So I rather spend time looking at those technologies and looking at those new ways of doing things. Also, for out of my own interest in actually doing something that I really enjoy doing.
Of course. Yeah, and how, I mean, you don't have to tell me explicitly, but how much is that data? I don't imagine it's cheap, and I imagine it's probably out of reach for the majority of people, wouldn't it?
Well, you'd be surprised. Some of it is actually quite freely available. Quite a bit is published by governments. So governments often have a policy where they disclose a lot of free data, and it's more a question of finding those data. So the most difficult thing for me is to actually find some of those data sets, and I'm working with some people that are more in contact with what governments provide also, and out of that we sometimes get quite interesting ideas of where to go.
Governments aren't providing satellite imagery, though, are they? Are you talking about like alternative data sets?
Yes, for example. So obviously there's also providers that do provide satellite imagery data sets, like the ones I've said, where you look at car parks and so on, and they obviously do the data crunching already for you. But those data, yes, they're very expensive, and for a typical retail investor, that would be completely out of reach, I would say. But as I said before, there is quite a lot of government websites that provide very interesting data on many different topics, probably because of the freedom of information policies. And so there's a lot of interesting things you can get from those websites.
And then I imagine once you actually get your hands on those data sets, that the next challenge is to actually clean that data.
Correct, yes. One of the most difficult things really is to go through those data and do something with them, and actually get something out of them that is reasonably meaningful. Because often, those data sets are either really large or they're not necessarily very good. They have lots of gaps in them and so on. And so it's quite time consuming, but it's one of the things that bring me back to my work as a physicist. It's that detective work, figuring out if there's something interesting in there, and then see if I can make use out of it.
Yeah. And as this data is coming from so these are alternative data sets we're talking about. We're not talking about, open, high, low, close prices that you get every day from the market. These are data sets which aren't updated every day, I presume. Does that present a new set of challenges in of itself? Like, how up to date is that data? Does that matter,
Yes, absolutely. It does matter a lot. And as I said before, these, depending on what those data are, some of them can be used as factors in a model, depending on what you use. So those data are obviously not something that you can use for a minute-by-minute trading strategy. They're more long-term strategies, and in that sense, they're you could say, more fundamental driven strategies. But I'm actually more and more coming back to be interested in those, because specifically as a retail trader, it's not easy to make money in the short term, because of the spreads and commissions that you have to pay. And so longer term data sets, in my opinion, have become more and more interesting again. Plus the fact that I find that price action gets more difficult to trade on these days. Although, having said that, some of my factors in my models do rely on price action as well.
This episode is backed by TradeStation, a great supporter of Chat with Traders. See, the thing you need to understand about TradeStation is this: they'll hook you up, okay? With fantastic commission rates, an award-winning platform with no software fees, and a suite of powerful analysis tools, free real-time data, an advanced mobile trading app, and plenty more. No longer do you need to cough up for monthly fees. With TradeStation, you pay only when you trade. For stocks, it's a fixed rate of $5 per trade or 1 cent per share. Futures is $1.50 per contract, and options are very affordable too. Now take a moment to discover why TradeStation are a popular choice amongst active traders, and discover if TradeStation are a good match for you. Visit tradestation.com/traders. At this link, you'll also find instructions on how to open an account. Once more, that's tradestation.com/traders. Also, this episode is brought to you by Jet Smarter. So if you want to be a baller and fly around in a private jet, here's what you should know. Jet Smarter is the mobile app revolutionizing the industry of private air travel. Jet Smarter lets you create on-demand flights anywhere on the planet, or reserve seats on shared flights worldwide, all within a matter of minutes from a single mobile app. No prepaid hours, no expensive brokers, just innovative air travel at your fingertips, so you can experience aviation as it was meant to be. With Jet Smarter, flying private is now within reach. Download the Jet Smarter app today and use the code SMART to become part of the world's largest members-only private aviation community and discover a smarter way to fly. For full details and to learn about the unparalleled member benefits, visit jetsmarter.com. Well, let's start stepping through your framework. So obviously we've spent a little bit of time here talking about different data sets, and once you've got the data, you've cleaned the data, what's the next step in your framework for strategy development?
So I'm using a framework that is basically a factor tester, and there's some interesting. I've built my own modified from something that I found open sourced, but there's actually some interesting open source projects out there where you can test factors, and one of them that I would like to mention is one called AlphaLens. So in AlphaLens, you can basically put in your universe of price data, as well as the factors that you would like to investigate, and then you can see it spits out basically a whole lot of analytics on those factors and different portfolios that you can trade over time. So that's one of the really useful tools. So that's really the first step. And once this is the case, I use my own algos in Python, mostly written in Python, where I then get the data in, and so the price data and also my factor data, and then I set up the algorithms, and that is then connected to my broker for trading.
Okay, can we just go into how you test these factors a little bit more? And just so we don't lose anyone, do you mind explaining what a factor is? Like, what does that mean?
Okay, so what is a factor? A factor is effectively something that is somehow correlated to the returns of the price of, say, a given stock. Let's say we have, just for the sake of simplicity, we have the price of gold, and we say, well, the price of gold may be correlated somehow to the price of oil. And what we can then do is we can take that price of oil as a factor and apply, or we do what you call a Spearman rank correlation, and then we get something from that factor which is called the information coefficient. And this information coefficient tells us something about how much information that factor has to the returns of the underlying asset that we would like to trade. And if the information coefficient is sufficiently large and interesting, we might considering trading that, because it just simply means that it has, or the change of this factor has some sort of impact on the change of the price of the underlying asset. Does that make sense?
Yeah, so this information coefficient, that's essentially what you're using to gauge whether this factor has any predictive power.
Correct. So there is an interesting formula, and it's from a book called Active Portfolio Management, and it basically says that the information ratio, which is in some ways similar to the Sharpe ratio, is the information coefficient times the square root of the breadth of our strategy. And when I say breadth of strategy, what I mean is how many assets do we trade, and what's the trade frequency that we have. So the breadth is somehow related to that. And so if we can increase the information coefficient, then we can usually increase the information ratio of our strategy. But that's obviously not the only thing. We also it's also dependent on our trade frequency and how many assets we might trade.
Let's say that you have this factor which has shown that it has some predictive power. Okay, so obviously we only have data historically, so you can see that historically this factor has had some predictive power. What gives you confidence that that factor is going to have predictive power moving forward?
So first of all, that you cannot necessarily be very confident about this, because you can never be confident about the future in any way. The way to do this, once you have a few factors, is to actually run a proper backtest. So I have actually written my own little backtesting platform, which I have even open source somewhere, but it hasn't got any manual with it, so it might be a bit tricky to use for people. But basically, in order to actually determine whether a factor or a group of them has any merit, one of the things that I would still do is run what I've explained to you earlier. I separate my data into a training test period, and then run the correlation between train and test, and see what the results are, because my strategy itself still will have a whole bunch of parameters. Even if the factor in itself is not necessarily a parameter, we will have probably a group of factors that make up a strategy, and these factors can obviously be combined in multiple ways. So they can be added, but they can be also combined in different ways. They could even be multiplied or whatever works. So all these things need to be tested, and so a good backtest is really essential to make sure that what we are looking at really has any merit.
Yeah, I guess now is probably a good point to ask how you reduce the possibility of overfitting. Like, how do you deal with that?
So there's really several ways of looking at it, and so I talked about this with you earlier, and I'm not sure whether that was on record or not, but may I explain it again?
Yeah, go for it.
One of the ways to do that is to separate your data into a train and test set, and then run your strategies with do a parameter sweep basically, and run that strategy or run the parameter sweep over your strategy and get the results. Which could be your P&L, your Sharpe ratio, or other metrics that you choose to use. And instead of then applying that to your test period, just like picking the best of your strategies or the most promising and applying that to your test period, what you actually do is you take all the parameter sets that you had previously run in your train period and also run them through your test period. And then what you do is you correlate the P&L values between your train and your test period, for example. And you have a look whether in those two periods have a correlation with each other. So if they do, and when I say this, I'm also saying I include strategy performances that were really bad. So say we have an exceptionally negative P&L, we also want to look at that, and we want to see whether our exceptionally negative P&L in our train period gives an exceptionally negative P&L in our test period. And if that's the case, what that means is that our strategy in the train period holds some information for what it does in the test period. And if there is this overflow of information from the train into the test period, on that level, we can say that that strategy has some merit. And so this is my main test for strategies, to see whether they are any good, whether they also help you to see whether you're overfitting in your tests, because if you have a decent correlation between train and test period P&Ls, for example, then you're most likely not overfitting as much. So if you just pick a strategy at random that seems to be good, most likely that strategy will be overfit. But if you look at the whole lot and the bigger picture, so to speak, you will get a very different sense of what that strategy is actually doing. Now, when I say that we get correlations between train and test periods, don't expect to get dead-on straight lines. That's most likely not the case. You will sometimes have certain areas where your correlation is really good. So you quite often find that you get clusters where you have a very strong correlation, and then you will get clusters with less correlation. But when you do this, you will usually get a very good overall sense of how your strategy might perform in the future.
Okay, I'd just like to pick up on something you said a couple minutes ago. You said that if you get a negative P&L in your training set, and you get a negative P&L using that same strategy in your testing set, that holds some information. I mean, what information can you take away from that?
Well, that in itself does not necessarily hold information in itself. Just if you pick out one specific data point, but the information really lies in looking at the bigger picture of the overall data set. So when you, for example, say, well, a strategy that performed really badly in my training set, but it's also performing really badly in my test set, that means, okay, so that strategy, or those parameter sets that I pick for my strategy, they perform in a similar way in both time periods, regardless of whether whether there's good performance or not. So if some of them perform really badly, and some of them perform really well, what you can say for sure is that, okay, so there is a correlation for how this parameter set does performs in the period that I've tested in comparison to the period going forward. And so that can give me much more confidence, because I say, well, whether it's a good parameter set or a not so good parameter set, we will know with some confidence that it will perform in a similar way going forward.
I just want to ask you, have you written about this kind of this process or this framework? Have you written about this on your website?
Yes, I have actually, because of the conference, the QuantCon that I attended a few weeks ago. I built a little set of blog posts that talks exactly about this and a few more things. If anyone's interested, I talk about this in quite great detail on my blog posts on my website, AAAquants.com. So you could have a look and see if things are not clear. Everything is there with the code. It points to a whole lot of code that you can use to do your own tests, basically.
Yeah, I'll make sure to include a few links to that in the show notes, because I know you've got like a series of posts kind of step by step walking through this, which might be helpful to some people if they're interested in this sort of thing and find it a little bit hard to keep up with. But and just to be clear, your website is AAAquants.com, so it's not triple A as in the word triple, it's AAAquants.com.
That's correct, yes. I actually used to have quite a popular blog previously, but I had to shut this down from my company. So unfortunately, I couldn't have this any longer. So for all the people who used to read my blog, I'm really, really sorry, but I wasn't able to keep it up.
Oh, that's a bummer.
So I'm just basically with the new website and the new business that I just started. I just thought it would be nice to start a few blog posts again and get some interesting information out there. I mean, none of this information is really secret anymore. I think what I've done was really just to take what some people have done previously and just put it into a format that is a little bit easier to understand, because a lot of it is in its original essence really, really academic and quite difficult to grasp. But once you wrap your head around it, it's not actually that hard.
So just continuing on this path here, I guess the next thing I wanted to ask you about, how do you test for robustness?
Okay, so this is one of the ways you can test for robustness, the one I just explained. But there's a few others, and let me talk about a few more that are, in my opinion, quite important. So one of them, I haven't really got much of a name for it, but I have seen it referred to as so-called BRAC test: build, rebuild, and compare. And so what that does is it basically, if you have a strategy that you're interested in, you take that strategy and you run it. Say you have a 10-year period that you want to backtest it on, and perhaps you just run it over different random or more or less random 1-year periods within that 10-year period. And for each of those 1-year periods, you get a certain result. And you will end up the more you do that with a distribution of results, so for example, a P&L distribution from all the different strategies, from all those different 1-year periods, and so you could. It's maybe a bit difficult to imagine. So you're not just starting then at year 0 to year 1, and then you go from year 1 to year 2, but you start at random points in your 10-year cycle and just run that strategy for this 1 year in any of the given points. And what happens is you end up with a P&L distribution, and this distribution has a mean. And that mean of that P&L distribution is usually, obviously you need to adjust it for the fact that you deal with shorter time periods, but given that you've done that, that mean will usually be a bit smaller. There will be a shortfall between that and the overall mean of the strategy you've been running for the whole 10-year period. And quite often, when you look at the shortfall from what you ran during the 10-year period to your distribution of the 1-year period and a mean of that, you get a sense of what will be the shortfall of your strategy going forward. So that's one of the ways you can look at robustness of your strategies. Again, it's somewhere referred to as the BRAC, build, rebuild, and compare test. So does that make sense?
It does make sense, actually. It seems like quite a clever way to look at a back test, like an alternative way.
Yes. You can obviously combine this also with what I said previously. So
okay,
you can put them in conjunction as well.
So I know you explained this just then, but just so we're really clear on it, what extra insight are you going to get from doing that, rather than just looking at, you know, a 10-year back test? Let's say you're back testing over a 10-year period. Instead, you might be looking at 10 1-year periods, all kind of randomized.
Yes.
What extra information or insight is that going to give you? You said, I know, Archie, it's coming back to me. You mentioned it's going to show you some of the shortfalls of that strategy. What might be an example, some shortfalls that you might discover?
So let's say you do this and you get a shortfall of 25% going forward, and then you start running your strategy and it goes okay, and then you end up in a drawdown that is a lot larger than what you expect. You might want to consider switching off your strategy, because there might be something wrong with it. So one of the things that this test can give you is a sort of metric of what would be an acceptable shortfall going forward, or when it would be time to switch off the strategy and to actually go back to the drawing board and go, what's really, is there something happening here that I don't understand?
And on the topic of robustness, I think you've written a little bit about using Monte Carlo. Can you tell us a little bit about how you use Monte Carlo for strategy development?
So Monte Carlo is like a really broad term. It basically, all that means is you use somehow randomized parameters or randomized something. So for example, when I just explained the BRAC test, and I could effectively have a randomized entry point for my 1-year period. So I could say I start at day 3,426 of my strategy. So that would be effectively a Monte Carlo approach, just randomizing the time periods that I test. Another Monte Carlo approach would be when you do a parameter sweep. So let's say you have 3 or 4 strategy parameters, and you want to somehow do a test. Quite often what happens is, if you have enough parameters, there is no way in the world you can actually cover all of those parameters. So meaning you can run through all the strategy parameters. Your backtest would probably run a few years. So what you could do is you could randomize the selection of those parameters, and what happens is in Monte Carlo, it gives you a relatively homogeneous coverage of your parameter space. So instead of just covering them with a rectangular grid, so to speak, you just choose random points. So where you have parameter A, B, C, D randomly, and so you get a decent homogeneous coverage of your parameter space. I mean, there are some clusters there, but it's overall relatively homogeneous. And one of the advantages that has as well is that if you were to use or run through all the parameters that you have, say you have 4 parameters and each one goes from 0 to, or say from 1 to 10. You start with 1, 1, 1, 1, then you do 1, 1, 1, 2, 1, 1, 1, 3, and so on. Over time, you end up with some sort of cube that keeps expanding and growing into your parameter space. Now, let's assume the time for all those backtests takes far too long. You would have to switch it off. Then your whole parameter sweep backtest would have only covered a small cube. If you use a Monte Carlo method, you could cover that space more evenly, more quickly, and you even if you have to terminate your whole parameter sweep early, you would still get a lot more information out of it than if you did that in a more structured, strict way where you just sweep through the parameters from the smallest to the largest.
Right. Okay. Yeah, I mean, we're starting to get a little bit technical here, I think. But,
yes, but it's technical in some ways, but it's also quite practical, because if you do this, you just end up getting faster results, really. So it's just a better way to do it and to get really quick results, rather than trying to go through everything and wait for a long time at the end to terminate it because it takes too long.
Are you ever worried about data mining when you're developing strategies? Like, is that something that ever crosses your mind?
Absolutely, yes. I mean, it's really one of the big problems, and that's very much exactly why I'm doing the techniques that I've described to you. So they will really help to get to grips with data mining bias. Of course, you can never fully eliminate all data mining biases. You can only try to make sure as much as you possibly can to reduce it. So it's always a worry in the back of the mind. And when you finally run strategies, you can never be 100% sure that you have fully eliminated data mining bias, unless you do something like not use any parameters, or you just randomly pick a parameter set in the hope that it'll work. But other than that, it's very, very difficult to do this. And of course, there's this thought that you should just come up with something that makes sense and test it a little bit and then run it. That also, in my opinion, has a lot of merit. Since I come more from a physics background, I'm always more interested to drill into these things a bit deeper and try to understand them deeper. That's why I choose the approach that I choose, basically.
Yeah, actually, that's something I wanted to ask you, because, all the things you describe in here, it's very scientific, it's very quantitative. Why do you think that you've pursued this path as a trader? Like, back, I think it was around 2000, you said you were doing a little bit of hand trading and intraday day trading. But, your career, through your career, you've pursued quantitative and algorithmic trading. Why do you think that is? Do you think it's just something which best fits your nature? Do you not like the characteristics of discretionary trading?
Yeah, I quite enjoyed discretionary trading when I did it, but actually, when I'm honest, I'm just equally interested in technologies and how you can use scientific ideas to get something out of a trading strategy. And I guess in some ways I'm also interested very much always in future technologies. So I was always really fascinated by how you could possibly use some of those scientific methods to extract viable trading strategies. And it's definitely not not always an easy approach. In fact, quite often, a trader with a good intuition will have often quite an edge over a discretionary trader over someone who does things in that sort of more quantitative way. But both of these things have their own merits and their own characteristics, and they are both in some ways valid in the market. So I'm just simply more interested in that. And then I have to say, like, I have this inherent fascination with seeing some of those strategies move in the market completely autonomous, and wondering sometimes why they are doing the things they're doing.
Yeah, and I'm glad you mentioned that you're interested in new technologies and that sort of thing. I know one of those things which you may have been referring to there is artificial intelligence and quantum computing. I'd love to spend a few minutes talking about those subjects. It's not something we've spent a great deal of time discussing on this podcast in the past, so I think it might be interesting to make the most of this opportunity as you know a bit about those things.
Sure.
What's piqued your interest in artificial intelligence? Like, what involvement do you have in it? Is it something that you work on and implement, or how have you got interested in it?
It's definitely something that I got more and more interested in recent years, simply because it's just something that is really one of the big up and coming technologies. And it's already been used very successfully in many other fields, and particularly if we look at the Googles and the Facebooks and face recognition, the series, voice recognition, and so on. Now, a lot of people in the space of machine learning and AI think that all we need to do is get a whole lot of data and then apply them to our machine learning system, and then we can predict the stock market. But unfortunately, that's not quite the case, because unlike, for example, if you do face recognition, the dynamics of the stock markets change, whereas the dynamics of human faces may change over hundreds of thousands of years, but definitely not over hours or minutes. So in that sense, using machine learning for financial data sets is a much, much harder problem. And there is probably, I'm not aware of many systems that actually use pure artificial intelligence to actually make full trading decisions. I know there's some of it out there that is running and that probably produces some decent results. But considering all the hype that's out there, I think we've still got quite a long way to go until we really see fully fledged AI systems actually running automated trading strategies. So that's something fairly futuristic still.
Yeah, I mean, there's certainly a lot of hype around artificial intelligence, but it kind of seems like that hype is really just that. It's a lot of hype. I mean, I don't know enough about the subject to really comment on it properly, but that's the kind of impression that I get, that there is a lot of hype around it. But like you said, you don't really know of anyone or any places that are using pure artificial intelligence to run automated trading systems.
I know of some systems that do this, but I think ultimately underlying most strategies, there's still some economic rationale of some sort, and they're not purely mostly not purely driven by artificial intelligence. But having said that, those systems get smarter and smarter, and people come up with new ideas. And I definitely would not rule out that those systems are soon coming to rule the markets. So I have a very strong feeling that sooner or later these systems will definitely come in, and they will actually make trading decisions on a regular basis.
When you say sooner or later, what sort of time frame are you talking about? I know this is very difficult to predict, but like, are we talking maybe the next 2 to 5 years, or are we talking about 10 to 20 years sort of thing?
I would say in 10 years you will see a lot of it. But that obviously is just my personal guess,
Of course, yeah.
which has no real no real basis other than guessing.
And what's that going to mean for your regular trader? Like, is it something we need to care about, like, or is it just going to be business as usual?
I think that the markets will definitely become a lot more efficient through it. It will definitely become a bit of a robot wars. However, I think, there's also always, where there's difficulties, there's opportunities. And I can see that perhaps there will be a point where, you start people using robots, and perhaps a lot of them using the same more or less dumb robots. And there comes a point where humans can see patterns again that weren't there before because they're caused by the robots. And then a savvy trader will find new opportunities in that market to deal with the robots somehow. It's not something that I can say for sure, but I could see this happening, definitely.
Yeah. I mean, that sort of thing kind of already happens in some ways, doesn't it? Like, I know there's, some traders, especially order book traders and guys like that can, I don't know, try to sniff out like the HFT algos and that sort of thing, and trade around them, try and trick them, and play those games.
And I mean, a lot of it that we see now is not particularly sophisticated. And at the moment, I'm quite interested in looking at cryptocurrencies. And you see, because it's so easy to hook up an algo to cryptocurrency, there's a lot of those games happening. And you can see even in the last year or so, from what I've seen, the ways people run their algos on crypto currency trading, they have become quite a bit more sophisticated. And I guess the other thing that is still there at the moment is that there's not many rules to play by, so people can come up with all sorts of things that probably would be highly legal in any other stock market, but they're still quite acceptable in cryptocurrency trading. So I think we're going to see a lot of interesting movement in that space in the near future.
Okay. And the other thing I mentioned that you had an interest in was quantum computing. What is quantum computing? Like, what are we even talking about when we bring that up?
It's interesting. It really started that with my meetup group, with cyber traders. We decided to organize the world's first quantum computing hackathon, or quackathon as we called it. So basically, a quantum computer is a new type of system where you have it. You can imagine it's a very highly parallelized computing system. So in a normal computer, you deal with zeros and ones at the very lowest level, where if you wanted to make a calculation, you have to feed it as zeros and ones sequentially. In a quantum computer, it's a bit different because of quantum physics. Zeros and ones are what you call superimposed, and so you can build these really large sets of numbers that all exist at the same time. So, for example, if you have one quantum bit, which is the equivalent perhaps of a transistor in a classical computer, you would have a 0 and a 1 at the same time. And if you have 2 qubits, you would have 2 zeros and 2 ones at the same time, which is already makes up 4 numbers. It's 2 to the power of 2. But if you have 10 of them, you already have 2 to the power of 10 numbers, which is a lot more. And if you imagine that you have 500 of them, you have basically parallel computing power that exceeds anything that is currently imaginable. Now, quantum computers are still extremely in its infant state, and there have been a few attempts to commercialize them. One notable one is called D-Wave from Canada, but also at the moment IBM open sourced one of their 5-bit quantum computers, so you can actually submit your quantum computing problems as a normal person to IBM on this 5-bit computer, and they're gonna solve them for you on their quantum machine. Again, this is still really new, but this is a up and coming technology, and it's moving with a surprising speed. So obviously, as a physicist, I'm very interested in that. Now, for most of us, we won't have to worry about quantum computers taking over yet, but again, in a couple of years, we will see more and more of that coming along and solving difficult problems. One of the things that quantum computers particularly good at is solving a specific type of optimization problem, and probably for most people that will be a little bit too over the head. It's called NP-hard, but it's a problem which is quite common. So, for example, there's this called the traveling salesman problem, where you effectively try to find the shortest path for a salesman between many different cities. And this problem is actually incredibly difficult to solve. If you have something like 20 cities, it takes you more than the age of the universe already to solve that exactly. But a quantum computer could do that really fast.
Why does it take so long to solve?
It's one of those problems where you have when you have enough cities, for example, you have an enormous number of different possibilities, and there is no specific algorithm to solve this. So you would have to really, if you wanted to solve this exactly, you would have to run through a whole lot of trial and error, and that would take a long time. But interestingly, problems like this also appear in finance. So, for example, if you wanted to say you had 10 assets and you wanted to do an arbitrage where you move money from one asset to the next, to the next, to the next, and you wanted to see whether you come out with a positive P&L, that's also another version of the traveling salesman problem. And that could be solved quite efficiently with a quantum computer. Yeah, then difficult portfolio optimization problems as well. So one of the things that isn't really solvable is a multi-time frame portfolio optimization. It's very, very hard to solve problems like this computationally. And again, quantum computers could really speed this process up very easily. We're not there yet, but we're not that far off, I would say.
Yeah, okay. So these hackathons that you're running, or that you have run in Sydney there, how are you doing that? Like, how do you have access to quantum computers?
So we were lucky to team up with a company that runs at the time when we ran it, the only available quantum computer was called a D-Wave, and it was a quantum computer that was situated in the US at Lockheed Martin. So we obviously wouldn't be able, we wouldn't bring the whole quantum computer over to Sydney, but we would just have access to it through a link. Now, for the sake of our hackathon, whilst we did actually have access to this quantum computer, most of the assessment that we did in order to find a winner was through simple or through actual classical computer models. So we were running people's submissions through these models rather than through the actual quantum computer. and it was more really about learning how do you program some machine like this. We had a few experts there. Some guy who wrote his PhD on a specific algorithm that he programmed, and so we had mostly few people from universities, also some from finance, all trying to build those little programs and come up with something that actually works. It was very, very interesting, and what you realize is that it's not easy. We definitely need a new type of programmers to understand these systems really well in the future.
Yeah, I bet. And that D wave you're talking about, how big is that?
It's about the size of a garage.
Wow. Okay.
So at the moment, they're not small. Mostly because the actual chip is just as big as a normal computer chip, but all the periphery to cool it down is very big. So what happens is these chips, in order to operate, they need to operate close to absolute zero, and all the periphery that makes up the garage size is basically to cool down the chip and keep it cool and stable, and also isolate the chip from cosmic rays and other interferences, so it can actually operate properly. So most of the quantum computer is actually not a quantum computer, but all the systems that sit around it.
Right. That's really interesting.
Yeah, it is fascinating.
So what happens when we start to pair artificial intelligence with quantum computing? What happens then?
This is definitely something that is going to happen, because when you look at artificial intelligence, a lot of it in its core. So if you look at neural networks and so on, in its core there lies a optimization problem. So you have so-called weights in those artificial intelligence nodes, and what you want to do is to minimize certain errors in those. Now, at the moment, this is done mostly with methods called stochastic gradient descent, but you can see that there is actually there's actually room for this new quantum technology to make that far more efficient and much faster, and also parallel. So once people are starting to combine the two technologies, I can't even imagine what we're going to see. I don't think anyone at the moment can imagine what the future will bring when those technologies actually start to come into our lives.
Yeah, it's pretty incredible.
They will definitely change finance a lot as well.
All right, well, let's wind things down. Thomas, I just want to ask you one last question. Just going back to algorithmic trading for a moment. Just one last question to take us out here. Through all the years you've been working in the field and working with others, and even the little bit of consulting that you've started to do now, is there anything you've noticed which less experienced algorithmic traders tend to often miss or neglect?
I think what's important is, or that's my finding, to really find out your own style. That there's so many different ways you can do things, and I think it's important to find your own style. So what I'm doing is not necessarily suitable for most people. They probably wouldn't find that particularly interesting. And I think when you go on that path of building machines that trade on the stock market, what you really should do is see what really suits you. Whether you like more simple models, but do them really well, or you use really complex data analysis tools. Figure out what really makes you interested, and what makes you happy and keeps you going, and do that rather than trying to do things that might not appeal to you. There's so many ways to make this work, but find your own style.
Totally, yeah, and I mean that's become just incredibly apparent to myself as well from doing this podcast. Just it's hard for me to say that any two traders on this podcast trade the same way. I mean, yeah, I'm sure there's a lot of similarities, and there are traders who trade in similar ways, but everyone does things a little bit differently, just what feels right for them. So I appreciate you coming on the podcast, Thomas. It's been
Thank you for having me.
An awesome conversation. Where can listeners go if they want to find out a little bit more about you? I mentioned your website earlier, aaaquants.com. Are you also on Twitter or LinkedIn or anything like that?
I'm on LinkedIn. My name just Thomas Starke. I also have a AAA Quants on Twitter. So you could follow that if you would like to. Other than that, I'm not overly present on social media, but you could always contact me through my website. There's also a GitHub page called AAA Quants. So if you go github.com/AAA Quants, you find a few interesting bits and pieces there if you're interested. And yeah, that's pretty much it.
Okay. No, good. So, everyone listening to this, as you know, I'll dig up all these links and put them in the show notes.
Perhaps one last thing. I'm also running workshops for Quantopian. At the moment, mostly in Sydney. So I've been recently running the advanced Quantopian workshop and also the basic ones. So if you're interested in coming to one of those, we usually give a lot of value there. So look out for them, and they're often quite good fun as well.
Okay. I know you just had one of those recently. Is there another one coming up?
There's probably another one coming up. We haven't planned it yet, but that's basically because I've been very busy. Oh, finally, as I mentioned, we also have a meetup group called Cyber Traders Sydney. So we meet in slightly irregular intervals, but usually every few weeks. So if you would like to say hello, also please come by, and you're more than welcome. It's usually run at Fishburners, a co-working space, and they're normally good fun. We have interesting speakers, and often we meet and socialize afterwards. So
okay, cool. Now those Quantopian workshops, whereabouts is there like a page of upcoming events is it on the Quantopian website, or are they best to check your website?
Yes, the best way to look is on the Quantopian website. They usually have a page of upcoming events, and so those events will probably be advertised there. So if you wanted to see whether there's one coming, please have a look at the Quantopian website.
Very good.
Okay.
All right, Thomas, let's wrap that up there, and
okay.
Enjoy your weekend. We'll talk soon.
Thank you. You too. Thank you. Bye.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.